All right.
There. Cool. Awesome. I'm just doing dishes.
All good.
So what is the topic today? Do we want to wait, or do we have anything that we want to talk about, or
I mean, so we're gonna have a couple more CFPs on this time. So it'll probably be your more like how to start investing, that kind of route.
okay?
But yeah, it should be interesting to get the Canadian approach versus American approach, a firm approach
Yeah, that's great.
on how to like start or get people started.
That's great. Perfect. Yeah, just let me know whatever you need from me. I have I have a couple of people that joined on over here. Yeah, Alex is here. Hi, Alex.
Awesome. Yeah, if they have any questions while we're waiting, feel free to ask them.
Yeah, and don't mind my face. I just had an allergic reaction, so I've got no makeup, no nothing. So don't mind me.
I'll appreciate the gift, Luz.
Yeah. You get the real deal. You get the worst version of me, but my brain works, so that's fine. So that's
That's
what's
all that
important.
matters, right?
TikTok doesn't follow me for my looks, so it's good. It's fine. But Alex says, "What's happening?" Yeah, I don't know. I had an allergic reaction over the weekend to something, and I don't know what it is. We have fires here and stuff like that, so I can't decide on if it's like something in the air or if it's something that I actually came into contact with. And then I woke up on Sunday, and my whole face was like blown up like a balloon, and I had to go to urgent care. And yeah, I basically spent 4 days in my house now, so it feels like quarantine all over again. And yeah, my two really good friends that I work with, they are like, "You look like you got Botox for free," and I was like, "Great, that's that's not the look I was going for, but okay, sure." So it's kind of funny. It's become a running joke. And then I woke up this morning with a cold sore. I'm doing great. I'm fine. Everything's fine. So it's really good stuff. Yeah. But I'm still here because my brain works. So that's the important part.
I'll be right back. I got a message, but
No problem. If anyone has any questions, let me know. Other than about my face. If it's questions about personal finance, I could definitely answer that. Just taking a probiotic, because, you know, when you're taking antibiotics, you should take probiotic. I love how they have to put on the back of this, like, because some of these have
Sorry, I don't know what happened.
That's okay. I was just talking about probiotics anyway, so it's not anything exciting. What time are the other people supposed to come?
So I joined pretty early. Everyone should be around like 3:25, 3:30.
What time is that?
So it's 2:42 over here.
Oh,
So
okay.
probably
So this
like
is
20, 25 minutes.
Oh, okay. So do you want me to hop off or do you want to? Because I don't
I
think.
mean, it's whatever's easier on your schedule. I'll probably just stay on and chat with whoever's near.
Sure.
But
Yeah. I mean, I'm just going to continue to do dishes unless anyone has any questions.
yeah,
So yeah, I'm happy to help. And yeah, I blocked off like an hour in my schedule for this. So whatever works for everyone too. So if you have any questions or if there's anything that comes up, let me know.
definitely. Yeah, Lewis, I'm having we have. I guess you can go and introduce yourself for the few people who are here if you want to
Yeah.
go ahead and do that.
Yeah, so my name's Kayla. I am a certified financial planner. I run a practice here in Canada. So I have been doing that for like 7 years. So it's been about 7 years. And yeah, I love talking about anything investment related, and I love talking about estate planning. I'm really good at estate planning. For Canadians anyway, because sometimes US stuff gets complicated. But yeah, it's just nice to be able to find kind of like like-minded people, and that's why I like TikTok because it's easy. So that's me. That's it. Very easy. Very easy.
Oh yeah.
How about you?
Me? Yeah, so Milesville, I work at a family restaurant. I do property management and then I do investing on the side. But I'm more the approach that just to show, hey, anyone and everyone can invest. So there's no, not to say no excuse, but no reason why saving money shouldn't be in your goal setting.
That makes sense to me. Yeah. I feel like sometimes I get asked a lot of kind of like questions about the basics of investing, and I feel like my answer is always very consistent, which is just to make sure you understand kind of like your risk and how much risk you're willing to take on an investment and match that with how long you have to have the investment. So if it's like less than a year, then obviously you're taking on the least amount of risk. And if it's 10 plus years, then you're taking on the most that you can handle. And those are the two kind of like really basic things that I think a lot of people forget. They'll just throw it into this and greatest stock that they hear about on TikTok, and it's just like, or an ETF, and not realize that it's extremely risky. And you're taking on, concentration risk. You're taking on risk that is sometimes very sectored. You're taking on risk that's sometimes not even close to your risk tolerance. And then people lose their money and then they overcorrect. And they're like, well, then I'm just going to leave it in cash or high interest savings account. And so understanding like your risk tolerance and your timeline are the two most basic and fundamental things that you should be doing when you're starting. And then don't overcorrect, because if you lose your shirt on an investment, it doesn't necessarily mean that you can't take on risk at all. It just means that you need to take more kind of like calculated and more educated risk rather than taking on crazy amounts of risk. So those are my two biggest tips. I don't know if you have any that you would like to share, but
No, I agree. And then I think the only tidbit I would add would be the goal of investing and saving is not really so much to make money, it's more to keep your purchasing power. So, like, if I go to a job and I make a W-2 salary, because of this thing called inflation, your price of eggs higher. My job doesn't necessarily keep up with the value of everything I'm buying. So when you invest, it allows for growth to keep up with inflation so that you can buy things at a reduced price for your lifestyle.
Right. Long term.
Right.
Yeah.
Yeah, don't come and invest and expect to get rich quick or buy things the next day.
Yeah. Especially like, I feel like some of the stuff, especially right now, because the interest rates are so high, there's so many kind of like mistakes that people can make. That would be my second thing, is just understanding that there's a difference between like the equities market and the fixed income market, and just understanding that, no matter where you are, fixed income, which is like the lower risk stuff, is subject to interest rate risk, right? So anytime the interest rates go up, that market's going to go down. And people forget that, and they think, well, I'm buying a GIC and it looks good. Well, you buy a GIC at 5% and the interest rate goes up the next week and your neighbor can buy one for 6%. Like, you don't actually feel that loss of 1% because you think that you're getting the 5% and it's guaranteed, but your neighbor is getting 6%. So there is a loss of 1%, but people don't think about that. They're like, no, I get a guarantee, so it's all good. But yeah, the bank is making that extra 1% that you're not. And oftentimes they're making more because they're making more educated and kind of like institutional level risk that they're taking on all of the money inside of the GICs. And so people are like, what do you mean? I'm like, yeah, like the banks take the GICs and they know they can make 4%. So they give you 4% and then they'll take the rest. And that's just how it works. And people are always shocked at that. Not to say that GICs don't have their place. It's just, they're not the answer to everything.
Right. No, and that's overall too. Diversification. Because there's, whether it's a CD, a ETF, a bond, target date fund, whatever, just doing one thing normally doesn't work. But the flip side of that is you don't want to be in too many things because then you lose compounding power.
For sure. Yeah. I feel like everyone, if they just understood kind of like those basics, people wouldn't lose kind of like their whole life savings, which happens a lot. I've seen people lose all of their money in a bull market, and that to me is wild. But it happens all the time because they choose like super speculative things and they think that they're getting the next best thing, and they lose everything in a market where you could have made 8 to 11. In 2021, it was like 35% just leaving it where it was. And people just didn't understand that. And they thought they were jumping off and getting on a new bandwagon, and they lost everything. So it's interesting to me. People don't think the basics of investing is like buying low and selling high, and people don't get that. I don't know why. Everyone knows it. They just don't internalize it and they don't do it. Yeah. Which is wild, but yeah.
Well, even too, it's, if you can, almost just try and approach it from a always be buying perspective. So not necessarily selling when high, but buying when low, and then always buying when low, and just allow things such as a dividend or whatever to be your 4% spending limit.
Right. Yeah. I mean, either that or, I mean, I feel like that's a good way to look at it if you're like growing long term. The majority of the people that I deal with, they're trying to take money out because they're retired. So I feel like that's another hard thing is like you can learn really easily how to save online or like through videos or whatever, but trying to figure out how to take the money out tax efficiently is really hard for people. I've had really good savers their whole lives. They made amazing clients. And then when they went to try and figure out how to take the money out, it's just like they can't quite figure it out. And that's because it's really complicated. And in the US, it's also really complicated to try and tax efficiently remove money from your investments. So there's like two sides to every kind of coin, especially during volatile markets. There's the people who are trying to buy and there's the people who are trying to sell, which is really why the market doesn't go to zero ever, because there's always people buying and there's always people selling. Even in recessions, there's people buying. And so it's really interesting to me to see kind of like people's investor behavior and how they respond to things. So yeah, if anyone has any questions, let us know. But I don't have any questions on my end so far. So
Yeah, so I have one over here that's since you mentioned retirement and dealing with people who retire, y'all have a version of the Roth IRA. I forget what it's called.
the
But
TFSA.
what's
Or
that?
are you talking about the Roth IRA is the tax-free one, right?
Yes.
Yeah, so we have the tax-free savings account, which
Okay.
is apparently the same thing. Yeah.
Now, so with that, they made a new thing with we have a thing in the US called the 529, which we use for educational purposes. But they just passed something that whenever you turn, I forget the age, I want to say it's 69, you're able to roll it into your Roth IRA tax-free.
Hmm.
So essentially you have two Roth IRAs.
Yeah.
Do y'all
For us,
see anything like that? Or
yeah, for us we have like the tax-free savings account is similar, but instead like where it differs is we get cumulative contribution room. So if we don't use our $6,500 in contribution room, we can use it the next year. And so it accumulates over time. Whereas I know that your guys' is a little bit different. I don't think that you can continually like go back and put money into it. Can you?
no, ours is a year.
Once a year?
So yeah, it's
Yeah.
around a year that you have to go back.
Yeah, so we have like cumulative over our whole life. So if you've never contributed to a tax-free savings account, you can put like 86,500 or whatever it is. And then that depends on your age, obviously, because if you were not around when the TFSA came into, then obviously you don't get all of the contribution room. But if you were 18 when it came out, you get the full amount and you can go back and max that out whenever you want. And then we have like something called the RESP, which is like an education savings plan for kids. And that I think ends around like year 59, and you can roll it into an RSP, which is like our 401k basically. So we can roll it into a tax deferred environment, but not tax free. So we don't get to roll it into the TFSA, which is fine because our government gives us a lot of tax-free room that we can use at any time, and it just keeps accumulating if you've never used it, which is really nice for us.
No, that's pretty interesting how y'all have multiple tax-free options where we pretty much just have one.
Yep.
Everything else is either taxed on the front end or taxed on the back end?
Yeah, the RESP, like the education one, is taxed when you take it out, and so is the RRSP, which is like the 401k. So it's also taxed when you take it out. But the tax-free savings account, which is like your Roth IRA, that one is more like it's the tax-free environment, I guess, but you accumulate it over time, so you don't need to do it all in one year, or you don't need to like keep up with it. You can do it whenever you want. So like lots of people sell their house, which is also tax-free here. So all of our principal residences are tax-free at this point. So so if we have a house and that has a gain on it, we get that tax-free as well. And so you could put, some of your proceeds of your house into the TFSA and max it out and have like that growing and potentially be worth over, $120,000 right now with the way the markets are. So it's nice for people who haven't utilized it to be able to utilize it. But that's the only two tax-free things we get is our house and our TFSA, and that's it.
Okay. So yeah, Invisible, with the 401k question, if your employer doesn't offer any good options, not financial advice, but just go up to the match in whatever their broad market index is and do not go over. Try and invest in other or have other accounts. But always get the match because that's essentially free money.
Yeah, that's the same for us. Like we often will say, I don't give like I'm a financial planner, but I don't give advice on like individual holdings because I have a license that I have to uphold. But we also say the same thing. Generally speaking, like having your maxed out how much your employer is going to give you, that's free money, so you might as well take it. But then you don't have control over the asset until you retire. So for us, we just say try and maximize your group stuff as much as possible, like your employer benefits. Same here. And whatever your max risk tolerance is, because you really can't touch it for a long time. So.
Right. Oh, and it has high expense. Yeah, you'd have to sit down and do the math, but if it's very high expense ratio, even though they're matching it, you'd want to see if it's worth your while. Most likely free money is good, but if you're losing more than you put in, that's not ideal.
Yeah. I mean, normally the way that group plans work is just they have institutional levels of money. And so they can invest huge amounts of money. So typically they don't take on that much risk. Like they don't want to lose everyone's pensions or everyone's group, 401ks or group RSPs in our case. So they will take on inherently less risk when they invest the money. So you will see kind of like a difference in rates of return when it comes to that type of environment. You'll see a little bit less just because they don't want to take on as much risk as you would take yourself. But that being said, it becomes a bit more dependable. So if you're looking at like the last year's return, it's not going to look good. But if you're looking at like the last 10 years return and it's matching with kind of like the guidelines of your risk tolerance, then you're buying every single paycheck. I think people also forget that like that money comes off of your paycheck and it comes off of, for us, our gross pay. So it goes into that account. It comes off of our gross pay. So we didn't have to pay tax yet on it. And you're buying all the time. So in a market where the fund doesn't look like it's performing, but the long-term rate of return looks good, that might not be like a terrible choice because you're buying while it's down. So, and you're buying all the time. So it's I think also like just making sure, just don't think so much like inside the fund, think more like broad spectrum. Like, is it a good choice based on my risk and your timeline's already really long. So I feel like that's kind of the two things that I would think about, less so like what the actual underlying investments are in the fund, because typically when you're dealing with like stuff, it's institutional level wealth, so they're already taking on way less risk than the average person anyway. So yeah.
Yeah, they'll only give you a handful to pick from, but out of those, they should have a relatively like index option that's pretty safe.
Yeah, I would say so too. Yeah. Or even if it's high risk, like their level of risk is not, like, people also forget that mutual funds and ETFs, you don't take on the same level of risk. Like, even if it says high risk, it's not the same risk as if you're trying to fund pick like a couple of different stocks. Like, that's extreme risk. So people think like if I'm taking on high risk in a mutual fund or an ETF or an index fund, they're like thinking that they're taking on like gambling, but you're not, because you're not actually gambling. There's still diversification that's achieved within those funds. And so that's the whole point. Like, it's like people forget too that you're not buying like Bitcoin when you say that you're taking on a high risk ETF. You're just buying something that's higher risk for that category. So people also, to me, when they come to me, they're like, I'm high risk, but like I don't want to lose everything. I'm like, well, it's nearly impossible if you achieve kind of like the maximum diversification that you could lose all of your money. Unless you're individually fund picking and you're taking on really speculative risk, which is a different thing. I don't do that. I don't take on that level of risk. I wouldn't be able to sleep at night if I took on that level of risk for clients.
No, I definitely couldn't do things like, for example, Kathy Wood and stuff like that. How you're basically picking, and that's her fun though. She picks newer companies and what is your quote unquote breakout sector. But yeah, that's a very high risk, and for that risk, she charges a crazy fee that I don't know. In my opinion, it's very steep.
Yeah. Those types of things are tough because the licensing is not necessarily lined up with kind of like, so if you're paying someone a fee, but you could potentially lose all of your money, like there's no risk for that advisor. Like for me, if I take on a client, I have fee for service based on how much assets you have. So if your assets go up, I get paid more, and if your assets go down, I get paid less. And for me, that's a shift from like a broker, where it's like you pay a broker a certain fee per transaction or per service, and there's no risk to them if they lose all of your money. You took on that risk, like there's no risk. But for me, it's different because if you make more money, I make more money. So like the value system is aligned, which I think people forget, because people are like, oh, I'm getting this person to just like pick my stocks and it's all good. But if there's no like alignment with how their compensation works, and then they don't have any, like, you better hope that that person's a really good person. Because if they're not, and you pick the wrong person, then you're in big trouble, because they don't have any, like, you sign forms that say you're taking on a certain level of risk, and their hands are clean. So it's a tough thing, because the industry is tough, because there's some people who just like take advantage of that, and there's some people who don't, and it's really tough to tell. You never really know.
Right. No, and there's also, you want to I'm gonna broad code it, so correct me if I'm wrong, but a safer choice if you're looking for a advisor or someone to help you is look for someone that is a fiduciary. Then
Yeah.
they're obligated to be in your best interest.
Yeah.
Don't don't just go for, the 10xer or the high performer or someone that has a name. I won't get in trouble for this, but don't go for the companies like even though they allocate risk at different levels, but like your Edward Joneses, they have a whole different model that they'll put you in, and their model may not be best suited for you because at the end of the day, they're more of a sales-based business. They want to get new clients, they want to push higher expense products, but they do offer safer stocks, but it's like a wishy-washy.
Yeah, I agree. Like for us, we have a huge problem with people who are just insurance licensed in Canada and they get to call themselves a financial advisor, and it bothers me all the time. Because, like, just because they can call themselves a financial advisor does not mean that they're educated enough to give you long-term financial advice. And in my opinion, if you have just an insurance license, you are not qualified enough to give like advice on retirement. And insurance is not the answer to everything. Like insurance has its place, but it is not a place for everything. And the reason people do it in Canada is just because insurance is less regulated. And so it's easier to maintain a practice when you have just an insurance license. And you can buy, like, we have segregated funds, which is basically like an insurance mutual fund. And people are like, you can just buy all seg funds and you'll be fine. But it's like a really expensive product. It's not the answer to everything. And it has its place, but it doesn't have a place in every single person's plan. And so when people come to me and they're like, my whole portfolio is in seg funds, I'm like, why? And they're like, I don't know. I was sold it. And it's like, you have to be really careful because, yeah, the fiduciary duty, like the CFP provides a fiduciary duty. I like that, but you also have to be careful on how people are licensed, because if you go to someone who's just insurance licensed and they have a CFP, like they're still only going to sell you insurance, which is tough for anyone. So it's hard being someone in the industry who takes this job really seriously, because I share a title with so many people. There's so many financial advisors who are in it for the product, and I'm not, and I share the same title as them. It bothers me all the time, but I can't change it because I've tried, and the government doesn't really understand it either. Our government, they're like, it's not on their radar, so it's tough. Yeah. I've tried to teach it. It didn't
I have
work.
a question over here for you, Kyle. Do you do any sort of U.S. investing, like in our index 500, for instance?
I do not dabble. I know enough about kind of like what Canadians who are also US citizens can invest in. That's kind of like my limit to what I know. So I know that if you're a US citizen living in Canada, I know what you can and can't invest in to just make the IRS happy. But to be a US citizen living in the US, I don't know enough about the tax system to give kind of like appropriate advice. So I wouldn't be able to answer that without speculating and guessing. And so, yeah. I mean, if you're living here, that's easy. But if you're living there, that's not easy. And so it's really hard. Again, the basics though, like you really have to just figure out what your timeline is and what your risk tolerance is before you decide on investing in ETFs. Because I always say, like, stocks and speculative stocks are kind of up here. Cryptocurrencies are like way up here. And then you've got your ETFs and your mutual funds and your bonds and your GICs and your cash, and that's like the hierarchy of risk. And depending on where you fall is how much you can maximize your handling of risk. So if you're a high risk investor, you can pretty much do anything below ETFs. If you're a very high risk investor, you can do all of it. So it's like, if you just figure that out, you'll know kind of like where you end up on the spectrum of risk. And you're not going into ETFs and you're not going into stocks. It's really hard for people to be medium and be comfortable with their portfolio going down 40%. So it's tough. So if you figure that out, you've kind of like got the rest of it. But yeah.
So how do you approach I go by percentages whenever I talk to anyone, but how do you approach the risk category whenever you take on a client?
I have a whole like 13 like step questionnaire that we go through that basically helps me to understand how you handle risk. Like, what's your job like if you have an entrepreneurial role and you have variable income, inherently you're more likely to take on more risk. So if you're a business owner, like, you're already willing to take on risk because you are willing to not have income. And so that puts you in a category that's a bit higher risk. And then if you've got, so I assess two things. One is risk capacity, which is how much risk you can take on, and risk willingness, which is just like how much you're willing to take on. So those are two very different things, because as an entrepreneur, like I have a risk capacity of very high, because I don't mind not making a paycheck. It's fine. And I also know that I have a long time horizon, which increases my risk capacity. But do I want to take on that level of risk? No, I'm more of like I'm a high risk taker, not a very high risk taker. So there's like two different things when you're assessing. It's like, how much could you take on and how much are you willing to take on? And those have to do with like your timeline, how long you want the investment to be in, the market conditions, your job, like how much of your assets are invested and how much are in your house, how much are in your bank account, how much do you have for an emergency fund. Like, if you've got all of those things quite healthy, then you end up having a higher capacity to take on risk. If you don't need the money, that's a higher capacity to take on risk. It's just like, there's so many things that you need to look at just beyond someone's willingness to take risk. Like, if I have a conversation with someone and they're like, I'm an entrepreneur, I have all this money sitting in my corporation that I don't need, I am never going to use it until retirement. Like, all of those things scream to me like higher risk. But then I talk to them and they're like, I'm actually nervous about what the market's doing. I don't want to lose more than 30%. Like, that automatically lowers them down the hierarchy of risk. So it's a conversation that has multiple facets. And then once you get to what they're comfortable with, it's easy for me to figure it out. But again, people can go the opposite way. They could be like, I'm actually a low risk taker, but their capacity is high risk. And it like brings up a conversation like, what are you actually scared of? Well, they've lost their money in like speculative investments, or they've lost their money in like, 2008 financial crisis, or they gave their money to their friend and they lost all of their money. Well, then their risk capacity and their willingness to take on risk really doesn't line up. And so oftentimes those clients will end up taking on a bit more risk once they figure out kind of like how everything works and we're not gambling. Then they're like, okay, we'll take on medium risk instead. So it can go both ways.
Yep.
Yeah.
No, and that's a good point too, is I know I've made my good share of mistakes, but the point too of an advisor is to help you avoid those mistakes so that you don't have okay, I'll buy something my friend told me because they heard it's the next thing and it's supposed to 10x, and you lose all your money
Mhm.
So, and it's a painful lesson. Hopefully, it's a lesson for you. But the job of an advisor is so that you don't have to learn that lesson.
Mhm.
But it happens. My thing is, if you want to try and go do it yourself route, I always say go in percentages. Like start small. Just put if you want to do a speculative position, just do like 4% of your overall net worth.
Mhm.
Don't don't go crazy. Don't go anything above 10. Just start below 10. 4 is, I think, good. 2% maybe safer, but yeah, I think that's the way I would phrase to approach it.
Yeah, I agree. I feel like you could even take that like a step further and then just figure out the pot of money that you want to invest and then really don't go more than like 5% in any given sector and try and really diversify yourself. Um, the more you own, even in smaller amounts, the less risk you're taking. Like you're inherently taking on less and less risk the more you own. So, like, I totally agree with you. Yeah.
You have any questions on your end, or?
I don't know. I feel like I've had a couple of people like bounce in and out, and then yeah, I don't really. There's no questions on my end. So, do you know when everyone else is going to get here, or do you think I should hop off? I don't know. What do you think?
Um, it's 3:18 here, so we still have a good 15 minutes. So, it, up, I guess it canceled. All right, I'm gonna end it, and I'll join on in a bit.
I don't know what happened.
Yeah, I don't know. But yeah, so we have about probably 15 something minutes. So, if you want to do like a pause and come back, or
Yeah, yeah, maybe I will, and then I can charge my phone a little bit, and then I can hop back on.
sounds good.
Okay, we'll see you in a bit.
Awesome.
Thanks. Bye.
All right, everyone. I'll be back in a minute.